John, thank you for taking time being on our show today. From a taxation point, what are some of your recommendations for our European investors?
That's right. That's right. Yeah. So from a taxation standpoint, they would have to. Usually, what we recommend is that they set up either an onshore and offshore entity to have the deals run through, so that they can either run through an onshore entity, meaning a domestic entity here in the United States, either an LLC or an S corp or something like that, where they could do the deals through, or they could do the deals through an offshore entity, meaning establish an entity in places like Caymans or Bahamas or one of the islands or something like that, or even an offshore entity that does accept inflow into the United States capital. So we've seen it done both ways. We've seen capital coming from an offshore entity or an onshore entity. It's easier to do it through an onshore entity, but they do have to deal with more taxation issues on an onshore entity. But if it's a flow-through entity, it may cause less taxation from their end, because a flow-through entity, meaning if it's an entity that is used strictly to do, it's a flow-through, meaning any kind of distributions or cash or earnings that come through that entity will end up flowing through the owner, and it's up to the owner to file for taxation. So the entity itself will only get taxed based on its earnings, and if it's distributing all its earnings to the principals, there won't be anything to tax per se. So that's why it's a flow through entity. However, they do have to take care of taxation on their end for whatever the taxation code is on the country.
Tell us about your fund. Is it a value add, opportunistic? Tell us a bit more about it.
Sure. Yeah. The fund it's a value add fund, but is it also opportunistic in nature, meaning that we obviously seek some kind of a disconnect in all the opportunities that we try to buy in the fund. Meaning there has to be some disconnect between the intrinsic value of the asset and what we can accomplish out of it, obviously. So. And that disconnect can be either in the form of mismanagement that the asset is experiencing, or possibly rent that are under market for some reason, whether it's because the asset has not been updated or requires more updating, or maybe again, it goes back to the mismanagement. Maybe they just don't know that they need to upgrade the rents that they used to be under to be market rate. So any of those scenarios will cause hopefully the asset to sell for lower the cap than it could, or in that case higher caps, because the cap rate works when it's higher, it's a sales price. So so that's what we look for in the fund. I mean, we are value add players. We mostly play in the B and C. That's the other aspect of the fund, is that most of the assets that are going to be placed in the fund are going to be in the B and C class. And for those who don't know the differentiation between the classes, obviously starts with A, which is the luxury, and it goes all the way down to D, or below that. So you're talking about affordable housing, or that kind of stuff. So we are in between. Most of the world we play in is the B and C. So we're not buying the really distressed assets, and we're not buying the luxury assets either. So
essentially what you are saying is that you take an underperforming asset and reposition it so you can deliver better results, let's say C's to B's and that kind of thing.
That's the play. Either repositioning C to a B, or C to a C plus, or B minus to a B, or B to a B plus. There's got to be some added value. That's the added value play that we take on all the assets that we buy, and that is done through either a series of things. Mostly, it usually involves some interior renovation for the units. The interior renovations could range anything from spending $2,500 up to $8,000 or $10,000 per unit. That's it.
So what is the typical deal size you guys look at?
So we typically look. We don't like to buy now. We don't like to buy anything under 150, 140 units. So usually the deals we look at are 140, 150 units and over. Between 150 and let's call it 350, 350, 400 units. So these are the deal parameters we look for. Our sweet spots is two 200, 220, 230 units, that's our sweet spot. We love those assets. That's typically the kind of assets we love to pick up.
And where are your target markets located?
Yeah, most of our target markets are southeastern focus. So anywhere from the Virginia, lower Virginia area to the Carolinas, North and South Carolina, to Florida, and all the way to we buy to Tennessee, and we're looking at other markets now as well. We're starting to expand our reach into looking into some Midwestern assets in places like Kansas City or Ohio, but most of our portfolio now, our current portfolio is southeastern focused. So in that area between the Carolinas and Georgia and Florida.
And how many units do you presently run, and how do you have your operations regarding economies of scale?
No, I'm sorry. Yeah, I was going to say, yeah, I mean, we are currently a 5,000 unit operator. So, and typically in our business, there are obviously certain inflection points that a company goes through in its evolution of growth. And that's what we are now hitting. We're hitting that inflection point of 5,000. There's typically several inflection points for companies like us. There's an inflection point of growth point between 1,000 to 5,000, or maybe 2,000 to 3,000 to 5,000 that companies go through and have to absorb. And then the next inflection point is 10,000. So right now we hit that inflection point of 5,000. Now we're at that inflection point. We're looking. The next evolution is going to be 10,000 between now and 10,000, and then we're probably going to go through another evolution when we hit 10,000, and that's going to be our next inflection point. Is 10,000 to, let's call it 16, 17, 18,000, and then we'll hit another inflection point then to hopefully push on beyond the 20,000 units time frame.
But do you self-manage with all your resources?
We do. We have we do 90% of our assets are self-managed. So we have our own property management company. It's called Capstone Multifamily Group. Capstone Multifamily Group is essentially our asset management arm for the company. And that's where most of our employees are. Most of our employees are on our Capstone Multifamily Group platform. We employ in the excess of 160, 170 people, and most of those people are on the Capstone end. The rest of the employees are on the MACC Venture Partners end, which is our acquisition and capital arm.
Regarding the value add, just for our listeners to understand, you are only looking for C's to B's, same as location, because the numbers won't work with A's. Is this what you're saying?
No, and that's why we try to stay in the. I mean, you can upgrade it to have similar amenities, but I wouldn't call it a pure A, because a pure A to me, a luxury is somewhat new construction. You're going to have all your trimmings, such as granite countertops, stainless steel appliances, all the regular very good amenities like a luxury pool, workout facility. So it mostly has to do also with the area as well. You have to also look at the area. So there's also obviously the actual building construction itself. So you have A, B, and C in the building, in the condition of the building, and then you have A, B, and C in the areas. So if you buy a C apartment in a C area, and you try to upgrade it to A and give A amenities and charge A prices, you're really shooting yourself in the foot, because why would you do that? Because you're not the demographic. If you take your apartment rents from $600 a month to $1,200 a month, you're not going to get renters. And if you're in a C area, because they're not going to, you're taking part of. So you really have to match your class of the apartment physically to the class of as well. So you got to really be mindful of that when you're doing upgrades. You don't want to upgrade too much. Yeah, everybody would love to say, hey, I'll upgrade it to an A class, but at what cost? Are you giving up 10, 20% of your renters, or are you giving concessions to make the numbers work when you can just?
So it's always a cash flow play.
Of course. So you got to justify it with cash flow. I mean, cash flow is king. If your cash flow makes sense, then go to it. But if your cash flow doesn't make sense, and it's telling you your renters are going to walk away when you raise rent another $200, then don't raise the rent $200.
Do you buy assets with lots of vacancies, or you are always looking for stabilized properties with lots of tenants, like in the 90s range?
No, we buy typically stabilized assets. So what we call stabilized assets, meaning stable. And when I say stabilized, our description of stabilized assets is usually occupancy is over 80 to 85%. So there's already occupancy well in the 80s when we take over. So our objective is to sometimes either to increase that occupancy from 80, 85% to 95% or even 100%, or if we take something over that's occupancy, keep it at 93, 94, 95, 98% occupancy and upgrade the rent, obviously. So the rent increase is really and that's really how increasing the rent is how you're going to get increasing your equity as well. That's the growth play. So you have two aspects of deal in our business. You have the cash flow play, and you have the equity growth play. So some assets will give you, a lot of the luxury A assets in our business will give you the cash flow play, but they may not give you the equity growth play. Because if you're buying assets that are already at the top of the range, you don't really have anything you're not value adding anything. You're not changing anything for the apartments. The apartments are already maxed out to the max. So you don't really have, so you were hoping that the cash flow will pay the dividends, will pay the pref for investors, and that's your play. In our case, we look for both. We look for cash flow and we look for growth in the value of the assets, so that hopefully in 4 or 5 years, through increase of the rents, it will also increase the value of the assets itself. So you're going to buy it, sell. You're buying an asset at, let's call it, 6.5 cap, and hopefully in 4 or 5 years, you'll sell it at either 6.5 cap, or maybe you'll sell it at 6 cap, or 6.25 cap. So you'll make that differentiation, and that will obviously give you a more IRR.
So what's your typical holding period? Is it 3 to 5 years?
That's right. Our holding period is 3 to 5 years. That's our average hold time. Now we've held properties a little longer than 5 years. We've held them a little less than 3 years, or right at 3 years. But our sweet spot is that 4 or 5 years mark.
Tell us about some of the worst mistakes you have made.
Yeah, I mean, a lot of times the mistakes that we make, and we make mistakes just like everybody else. I mean, it's not, if we don't make mistakes, then if you meet somebody say, and they tell you we've never made mistakes, then you should. So I think the mistakes that we made is sometimes in the beginning we've a lot of times sometimes underestimated the capital requirements that you need in an asset. So we've made a mistake in one project where we did not account for the capex right away out of the fundraising that we did. When we did our syndication, we only syndicated based on the acquisition, but not based on the capex. And we ended up having to put in a lot of our own money in there because we didn't want to have a capital call to our investors. So we ended up injecting a lot of our own money and then holding back some of the cash flow from the rent to pay for some of the renovations, the interior renovations that we have, which was painful to do. If you have to hold back, 30%, 40% of your cash flow or more to pay for renovations, and then put your own money in there to make the numbers work in that 3 to 5 year time frame, it hurts. So and plus your investors aren't happy as well, because that's 30, 40% that's being taken away from their cash flow that's being distributed to them. So so that was a mistake that we haven't repeated since then, thank God. So we now, when we raise a project, when we syndicate a project, when we go out to raise money, we account for the capex from day one. So any capex expenditures that we need for our assets, we raise that money as well as what we need to buy the assets. So the equity needs or the equity raise requirements include not only the purchase price, but it includes also the capex that's going to be needed for the next 5 years for this asset.
Regarding capex, dealing with private money lenders, they typically hold back some cash reserves, capex reserves. Can you tell us our listeners a little bit more regarding that?
That's right. Yeah, and plus your lenders, a lot of times, if you deal with lenders here in the United States, they require a certain amount to be held back. They're what's called reserve. So they require you to reserve a certain amount of money for some of the renovations. So that's holdback that's money that you're not going to have access to. You're going to have to hold them back. So you got to account for that from day one. Otherwise, your project numbers will not work. So you have to account that from day one.
You could have all the know-it-all MBAs, they can do financials under 2 minutes, but they wouldn't be able to run a company properly because they lack the experience. Since you learn by doing projects.
Of course.
Can you talk a little bit regarding this?
Oh, of course. Of course. Yeah, you have a lot of smart people that know their numbers and know by the book how to do things, but not in the end when it comes to execution. So you have to learn by doing the projects and spending your time in the market. And that's what I tell people. I said, look, if you want to learn, if you want to start to invest, or if you want to start to be a player or sponsor, just do it. Just go in the markets and just do deals, because that doing deals is really the ultimate teacher. And if you're going to try to, don't try to time the market as far as, because a lot of people sometimes ask me, well, when is the best time to invest, and when is the best time to get into multifamily, and should I wait until next year? Should I have done it last year? Should I do it 6 months from now? I'm like, just do it. Just do it. Now is always the right time, because when you're in the market, that's when you see the deals. That's when you see opportunities. If you're not in the market, and if you're going to say, I'm going to be out of the market, not going to come in until next year. Well, what if there was really 2 or 3 fantastic deals that took place between now and next year? You're going to miss them. You're not going to. I guess so. But if you're in the market on a day-to-day basis, you're going to find those deals.
Regarding deals, how do you let your investors know that you got something new?
So usually we identify an investment or an acquisition, and if you happen to be part of our investor circle or investor group, we send out notifications. We do social media feeds. We do an announcement online. We do an announcement through our webpage and our LinkedIn, and like I said, our social media feeds, and usually we go to our investors directly and tell them. There's usually an email that we send out to our investors and say, here's the new deal that just our new acquisition, new syndication. Here are the parameters. Here's an investment summary. Here's the spreadsheet for the numbers. We give them. We are very, very transparent. And I think that's probably our number one requirement for doing anything with anybody is that we have full transparency on the numbers, because there's no reason to hide anything. You're going to see the same thing I'm seeing, and I'm going to tell you everything that I know about the deal. And in fact, we invite most of our investors, if they're always welcome to come see the deal physically if they want to. If they're in the market, we always say, look, take a drive-by, go by the asset. If you have any questions, let us know. You're always welcome to physically go see the asset. So you have to have transparency in this business, because if you don't have transparency, it's you don't want people to wonder, well, what is he hiding? What is there that I don't know? And you're going to have those people who are going to ask, is this too good to be true? These numbers look really fantastic. What is he not telling me? And so the more you disclose, the better in this business. And doesn't just go for us. It goes for, I would hope, for everybody in this business.
Do you also do joint venture deals when you find an opportunity that is too big for you?
No, sure, we do. That's a great question. We do JV deals as well, what's called joint venture deals. So we do joint ventures with other people where other managers or sponsors can be co-GP with us. So we're not the only GP. Sometimes they only come in on the LP side, on the limited partner side. But a lot of times we find good deals that are too big for us to take down. Right now we're looking at a big portfolio of multiple assets. I think it's got over 2,000 units. With another operator similar to us, so this would be a joint venture opportunity where they would participate in a deal as a sponsor, as a co-GP, just like us. So yes, we do joint ventures with other people as well.
Do you do developments as well?
We don't do developments. Yeah, that's not something we do. It's not our. We've not done developments before. Development is a very different animal than stabilized assets. development is a completely different game, and we just don't have the expertise. We are very good at what we do in multifamily. We're very good at.
So neither venture capital nor private equity.
That's right. That's right. We very specifically a multifamily operator and player, and doing development. It's just not our game, and it's not fair for us, and it's not fair to the investors. We don't want to learn on anybody else's expenses.
John, is there anything we haven't covered yet that is super important for our investors and listeners to know?
Well, I think it's probably important to know how you get paid, which is something you haven't. Yeah, we haven't talked about. I think most investors would like to know how they get paid participating.
My bad.
So typically in those type of syndications where there's we hinted about it a little bit in the beginning. I think you heard me mention a pref rate or a cash rate, and you heard me mention an IRR. And a lot of investors sometimes get confused when we send out the numbers, because we send out two returns numbers in our spreadsheet when we send out an overview of our investments. So typically there's a cash on cash number or pref rate number that we pay and that's paid out annually, but it also gets paid quarterly. So it's a distribution number it is an annual calculation. So let's call it 10%. Most of our deals, by the way, range between that for that pref rate or cash on cash rate is between 9 and 11%, 9 and 12%. Especially these days in this market, it used to be higher in the market that was 2 or 3 years ago. Our rate used to be in the teens, in the 12 to 14% cash on cash, but unfortunately we don't see those numbers anymore. The market is a lot tighter these days than it was before. So there's that number let's call it 10% per year. That's cash on cash. So that is, for the sake of simplicity, let's call it if you put in with us $1 million, your cash on cash, your pref return, your distribution is going to be $100,000, and that gets paid out quarterly. So every quarter you're going to get a check from us for $25,000. And that will continue for 4 years, or 3 years, or 5 years, however long we have that investment. And so at liquidation, or when we sell the investment, at sell point of the investment, let's call it 4 years from now, you are going to get another number. That's going to be the IRR number, the internal rate of return, and that's the number you make when we sell the assets. So if we buy the asset at $10 million, and 4 years from now we sell it at $14 million, you're going to participate in that $4 million equity bump that we see on selling the assets. So you're going to get another bump, or return on that when we sell. So when I send those numbers out, and that IRR number for us on deals now is averaging in mid-teens, so anywhere between 15, 16, 17% range, 18% range. So when people look at those numbers, don't just look at the IRR number. Sometimes people look at our deals and say, "Oh, I'm only going to make 16% on this deal." No. You're not going to just make 16%. That's what you're going to make when we sell the asset. But you're going to also make 10% year after year. So your cumulative return is probably going to be 2x of your money. So if you put in $1 million with us, by the year 4, you're probably going to make your total return is probably going to be $2 million.
So you have this set up as a waterfall structure. This is what you're saying?
That's correct. That's correct. So usually it's if we have a point where we get paid as manager, as the sponsor, we get paid more, and as if we make more for you, the investor, we get. If you get paid less as an investor, so up to usually, let's call it, for the sake of example, let's call it 70-30 waterfall. So which means 70% of that waterfall will go to the investor and 30% will go to us as the sponsor. And if we hit a certain threshold, and let's call it 20%. So if we exceed 20% IRR on sale, we get paid an extra bonus as an investor. So let's call it 5%. So it goes from 70% to maybe 65%. So as an investor will get paid 65%, and we get paid 35% if we go over that 20%. But it's a win-win for everybody, because that means you're making a lot more money and we're making more money. So it's only rewarding us when we make a lot more money for you as the investor.
So you invest with the investors as well.
Of course. Oh, and that's the other thing that I'm glad you brought that up. We we always, as sponsor, have skin in the game in every project we have. So we invest in every single project in the equity stack. So it's usually anywhere between 10 to 20%. That's our skin in the game in every project. So if it's a 10 million project and the equity play on that is $3 million, we are investing anywhere between $300 to $600, $700,000 in that project ourselves, as portion of the equity, and the rest of the equity is being syndicated. And then we leverage our assets. That's the other thing I need to mention is we leverage, meaning we take a debt out on 70% of our of the assets. So if the asset is $10 million, we're taking a debt out of $7 million on that, and we're syndicating only $3 million of the equity on that asset.
John, I'm a bookworm like you, and before this show, I sent you my last recommended book list. Tell us a bit more regarding your favorite books and some of your pearls of wisdom.
Oh man, I pearls of wisdom. I have so many books that I read. My nightstand usually has about anywhere between 7 to 10 books on it at all times. So I'm always reading. I'm reading multiple books at the same time. Right now on my nightstand, you can find a book called The Circle, which is it's somewhat of a fiction book. I have another book called Cattle Kingdom, and it talks about the United States back in the 1800s and how the cattle fever kind of drove the economics in the United States, because it was basically driven by the industry of the cattle industry. So that was a really interesting read for me from an economic standpoint, how things change, what you use economically back in 100 or 200 years ago to now. And it's an interesting book. I have another book right now on my nightstand, and I'm trying to remember the name of it. And like I said, I have like five books right now, but these are two right now that I'm trying to get through and read. But your book list is good. I love your book list. I always like sharing book lists with people and see what they're reading and see what I'm reading.
First time I picked up a Peter Lynch book, it changed everything. I read it again and again and again. And after the third or fourth time, I decided right there and then to quit my first company and become a full-time investor. This is a true story.
Absolutely. No, and keep doing that, because data and information is always good, and always keep updated on your information and your data. I mean, beside the books, I always try to stay on top of the publications, such as anything from New York Times, Wall Street Journal. Some of our industry publications, multi-housing news. They publish a lot of great stuff. The Blau Journal published a lot of great stuff. So you always want to know. I always want to know what kind of deals are being done. What are the parameters of the deals. And just pick up the phone and talk to people. A lot of times when I tell people is, hey, if you want to know more about me, pick up the phone and talk to someone else like me, and you'll figure out how we do business, and what's different between me and the next guy. And I'm always happy to give referrals to people before they do business with us. When a new investor comes on board, I always tell them, hey, do you want to talk to other investors? Do you want to talk to other players in the market? I'd be more than happy to provide you the numbers, because like I said, transparency is number one. We have nothing to hide, and there is no magic sauce. The magic sauce is really just doing the things that you do on a day-to-day basis, and continue down that path. And that's really the only magic to it. And really, surrounding yourself by the right people and the right partners. That's really the only magic. Otherwise, there is no magic to it.
John, finally, where can our listeners reach out and contact you?
They can reach me several ways. They can reach me by my email, John, John, at maccvp.com, maccvp.com. They can reach us on our website, maccvp.com, maccvp.com. They can reach me on LinkedIn. I'm always on LinkedIn under Jalal John Azar. They can reach me on Twitter. They can reach me on Facebook. I'm very, very accessible.
John, thank you for taking time doing our show today.
Thanks so much. I appreciate you. Thanks for having me.
Thanks. Bye.